Good afternoon, everybody. It's the Liberty Call for Tuesday, December 14th, 2021. Hope everybody's having a fantastic day. It's pretty pleasant here on the Front Range. We've got some nasty weather heading this way. So if I'm not here tomorrow, it means that the house blew away. So we're expecting anywhere from 40 to 50 mile an hour sustained winds with gusts up to, I think, in the 80s or 90s. So yeah, I'm hoping all the pine trees around my house don't fall down and crush me. So, but if you do see a video from me tomorrow, that means I have survived. I am scheduled to have an infusion tomorrow. So if it's a little late and I actually make it to it, so we'll see where that goes. So, but other than that, kind of a boring day. I haven't seen a whole lot of crazy headlines across my TV screen. Right now, they're talking about another economic shutdown. I'm not sure why we would do that. But anyways, all right, well, let's go ahead and take a peek at how the indexes have done today. Dow Jones was down 0.3. The S&P 500 was down 0.75. NASDAQ down 1.14. So it looks like the techs got the worst of it. Small caps were down 0.9. The VIX was up 7%, up to 21.89. So again, went up a little bit. You know, starts creeping up near 30. You know, then we might want to worry a little bit. As far as Europe, looks like Europe was down quite a bit, or not quite a bit, maybe anywhere from around 1%. Let's see here. Let's go down to Asia. Looks like they were down anywhere from about 0.5% to about 1 1/3. So looks like the world is pretty much in the red today. So, but nothing dramatic. All right. Well, I have a couple articles I want to share with folks today. So first one is talking about the Senate is moving towards raising the debt limit to $31.4 trillion. That is outstanding. All right, let's go ahead and read this. It's from Reuters by David Morgan and Richard Cowan. The U.S. Senate moved toward a vote on Tuesday to raise the federal government's debt limit by $2.5 trillion to about $31.4 trillion and forward the measure to the House of Representatives to avoid an unprecedented default. The vote allows months-long standoff between Democrats and Republicans, with the latter seeking to force President Joe Biden's party to raise the debt limit from a current 28.9 on its own, generating fodder for attack ads during the 2022 midterm election cycle. A deal between Democrat Senate Majority Leader Chuck Schumer and his Republican counterpart, Turtle Mitch McConnell, last week set the stage for Tuesday's vote, bypassing normal Senate rules requiring at least 60 of the chamber's 100 members to agree on most legislation. In an early afternoon procedural vote, the Senate moved along party lines to begin debate before the vote on passage, which was expected to take place as early as 4 p.m., I guess, today. The House will also need to approve the bill before sending it to Biden for his signature. Schumer says the increase would take borrowing into 2023 through next year's November 8th midterm elections, which will determine control of Congress. U.S. Treasury Secretary Janet Yellen has urged Congress to hike the debt limit before Wednesday. The increase is needed in part to cover debt incurred during Republican Donald Trump's presidency, because, all the debt was his fault. When debt rose by about $7.8 trillion, partly through sweeping tax cuts and spending to fight the COVID-19 pandemic. So we'll see. It's currently 4:30 on the East Coast, and I haven't seen anything come across the TV yet that they've taken care of this. So if you want to go ahead and read the rest of it, go ahead. It will be in the show notes. All right. Next article comes from Yahoo Finance. Morgan Stanley's Skelly still sees drop coming in stock prices, written by John McCrory and Jonathan Ferro. And this was published today. All right. The Federal Reserve is about to announce a faster taper on its way to raising rates, a sure sign that price multiples on stocks will drop as growth slows, says Daniel Skelly, head of market research and strategy at Morgan Stanley Wealth Management. There's more room to go on multiple contraction. He said Tuesday in an interview on Bloomberg's TV surveillance, things are somewhat tracking to a normal historical context, which has seen multiple come down anywhere between 10 to 15% as mid-cycle transitions culminate, God damn it, in the past. Skelly has kept his forecast for the S&P 500 to the end of 2022 at 4,400. So to give you some perspective, the current S&P 500 is currently at 4634. So that means he expects a drop of about 200 points by the end of next year. So about 5% from yesterday's close. Positioning has already started to move that way, particularly when you look at some of the faster moving institutional funds. Positioning has started to lighten up more recently, Skelly said. In the coming higher rate environment, he favors companies in areas like healthcare, which is trading extremely cheap after underperforming this year, particularly those names with all the benefits of innovation and growth, but not priced like many other growth sectors. He also likes consumer staples. That said, he isn't shying away from growth names at the right price. We've added to our team's portfolio recently names like MasterCard, names like T-Mobile. Skelly said these are structural growers that are significantly off their 52-week highs. To balance the portfolio as volatility increases, we put some money into alternatives, Skelly said. We've also put some money into shorter duration credit and high-quality credit. Probably not a bad idea. So at least one person out there in the interwebs has in lockstep with me that we're headed for probably some rougher waters when it comes to the market. All right, next article, FOMC preview, is the Fed behind the curve on inflation? This is written by Brian Chung. Let's see here. How fast does the Federal Reserve want to move on drawing down its pandemic-era stimulus? That's the question the Fed officials will have to answer in its two-day meeting kicking off Tuesday, which is today, where the major discussion will focus on the pace of central banks' wind down of its asset purchase program. With inflationary pressures continuing to rise, Fed watchers expect the policy-setting FOMC to lean into a speedier timeline. On Friday, the CPI showed price rising by 6.8 year over year in November, the fastest pace since 1982. For the Fed, which has insisted for most of 2021 that high inflation readings would be transitory, the concern is that it may have to play catch up to quell any fears of further inflation. Excuse me. If the market perceives that the Fed is behind the curve controlling inflation, it would lead to higher inflation expectations and long-term interest rates, potentially weakening the dollar and pressuring asset values, said Madhavi Bokil, Senior Vice President at Moody's Investors Services. Fed Chair Jerome Powell and his colleagues on the FOMC have already pledged to address any inflation that would jeopardize the economic recovery, pointing to the possibility of more hastily ending to the Fed's asset program. If things continue to do what they've been doing, then I would completely support an accelerated pace of tapering, San Francisco Fed President Mary Daly told Yahoo Finance on November 23rd. Since the depths of the pandemic, the Fed has been buying U.S. Treasuries and agency mortgage-backed securities in the open to signal its commitment to easy money policies. The Fed was pacing those purchases at a clip of about $120 billion per month until November, when the FOMC charted a path for gradual tapering those purchases to a full stop by middle of 2022. All righty. But Fed officials will now debate the merits of a speedier wind down and could wrap up purchases as soon as the first quarter of next year. Ask the curve itself. Luckily, the Fed can consult the curve. The yield curve, which maps out the yields of U.S. Treasuries across different durations, serves as a proxy for investor bets on future growth. Generally speaking, higher long-term bond yields and a steeper curve correspond with optimism over longer-term conditions. But several yield curve measures show a flatter yield curve. For example, the difference between the 2-year and the 10-year Treasuries fell to as little as 75 basis points, which is 0.75%, at the beginning of the month. When that difference falls below zero, markets usually brace for a recession. From the Fed's perspective, a flat or inverted yield curve is undesirable, to say the least, said Solita Marcelli, Chief Investment Officer at Americas at UBS Global Wealth Management. Marcelli said one reading of the flatter yield curve is the expectation that the Fed is behind the curve and will need to pump on the brakes abruptly via interest rate hikes to stop inflation. JP Morgan chief economist Michael Feroli told Yahoo Finance that he's not sure the Fed is all that behind the curve. Feroli said that the Fed had hiked interest rates as early as this year, or as early as the year. The strength of the economic market reopening would have led only to moderately lower inflation. They are a little behind the curve, but they can catch up to the curve. I'm quite certain of that, Feroli said on Monday. The FOMC begins Tuesday and concludes Wednesday with the policy statement due Wednesday at 2 p.m. So we'll see tomorrow afternoon what the Fed has to say as far as will they speed things up? Anyways. All right. Another article here. Here's what 8 financial planners say you should do with your money during inflation. So kind of apropos with all the inflation we're experiencing right now. This was written by Megan Leonhardt. With inflation rates surging at rates not seen in decades, many consumers are wondering how to keep rising prices from negatively affecting their savings and spending habits. Prices on consumer goods and services, including food, energy, housing, have been rising for the past few months. They jumped again in November, rising to 6.8% over the previous year. Along with rising prices this year, there have been also supply chain bottlenecks and rising consumer demand, all of which have caused real challenges as the average American's purchasing power degrades over time. While the effects of inflation are not easily avoided, several financial planners tell Fortune that there are steps consumers can take to duck the worst effects. First, avoid buying a car if you possibly can. Putting off a major purchase might be the right option now, especially on a new car, says Jay Zigmont, certified financial planner and founder of Mississippi-based financial firm Live Learn Plan. If your car works and it gets you to work, then stick with it, he says. That's because while auto loan rates are low, the cost of new cars has surged 11.1% over the past year, according to the CPI. But inflation on used cars is even worse, up 31.4% over the past year. Zigmont says, in general, car prices have gotten a bit disconnected from reality, and consumers need to ask themselves if they really need a new car right now. Try paying for a complete detailing of your car, and it will feel like new to you without the sticker shock, he says. For those with car leases running out in the next few months, financial planner Chris Diodato says it may be worth buying out the lease rather than shopping around for a new car or lease. Buyout prices, which are indicated on the initial lease contract, have been far below current resale value, says Diodato. All right, next, grow investments rather than savings accounts. One thing that makes inflation particularly difficult for savers is the low interest rate environment that the U.S. has been experiencing, says Matt Elliott. Your cash at the bank makes close to no interest, yet prices are increasing on everything you buy. That can cause your purchasing power to degrade over time if you aren't invested, Elliott says. He recommends consumers consider investing in a diversified portfolio that includes investments that will go up with inflation, such as Series I savings bonds and Treasury inflation-protected securities, or TIPS as we call them. Yet while the interest rate on Series I bonds is attractive, financial planner Jovan Johnson says investors need to put in the effort to understand how these work and how that can impact their timeline for this money. For instance, investors are generally limited to buying $10,000 worth of I bonds annually per person. If you can't sell these bonds for at least 12 months. If you redeem them in less than 5 years, then you'll forfeit 3 months of interest, says Johnson. Overall, I believe that I bonds are very secure and a great place to park your money if you don't need the money for at least a year, he adds. Many young people sit with lots of extra cash as they are unsure what to do with it, but that can be harmful now, says Thomas Kopelman. You should only have cash for an emergency fund as well as cash for short-term goals, vacation, down payment of a house, etc. Then you need to invest the rest. That's very solid advice. Think about buying more veggies. More than Any other strategy? Financial planner Elliot Appel recommends shifting what you buy from items that are highly impacted by inflation to items that have escaped the worst of it. Not all items have seen the same rate of inflation, adds Appel. Most consumers, for instance, have noticed grocery bills going up, but much of the cost increases are tied to rising food prices for animal-derived products, says Andy Baxley of Illinois-based CFP with the Planning Center. Experimenting with plant-based dishes is one way. I'm not sure if I'm going to eat plant food. Maybe one way to reduce the pain at the checkout counter. I'm encouraging folks to get creative with their budgets right now, he says. Or maybe instead of buying beef, buy chicken. Beef prices have risen 20.9% in the past 12 months, according to the CPI. Chicken prices increased only 9.2% over the past year, and the cost of uncooked poultry products, including turkey, is up only 4.6%. Meanwhile, shelf-stable fish and seafood such as canned tuna haven't seen any increases. So that's good. So, I'm a beef guy. I like my steaks and my burgers, so I'd rather just skimp somewhere else. Spend less if you can. This is a good time to reconsider your overall spending, says Dana Maynard. When necessities begin to cost more, discretionary spending should be reevaluated as not to neglect the things that are necessary, he says. This may be as simple as getting rid of or canceling unused subscriptions, but Maynard says it's important to consider where and how you're spending your money. That's especially true around the holidays when people make impulsive purchases, and gift buying can sometimes trump logic. Although it might not be as easy to make these changes right now, Elliott says the good news is that many financial experts and economists predict the current rate of high inflation will start to subside. Well, we'll see. All right. So, some good tips there. Just keep the very bare minimum sitting in US dollars, invest the rest. Certainly not bad advice. Go through your budget, maybe look for some other options as far as, what you're consuming. And, we'll get past this. All right. Last one. This is a tough time to be on a fixed income. The Grim Inflation Outlook and What Retirees Can Do. Written by Carrie Hannon. This was from MarketWatch. All right. Let's jump in. Inflation rocketed by 6.2% in the 12 months through October 2021. We already know that. Let's get to the actual good stuff here. Sadly, the outlook is getting grimmer for prices to settle back down anytime soon. The Organization for Economic Cooperation and Development now expects inflation in the U.S. to average 4.4% in 2022. And an Allianz Life survey found that 78% of Americans expect inflation to get worse. Over the next year, 70% worry inflation will keep them from affording the lifestyle that they want in retirement. This winter, the U.S. Energy Information Administration forecasts U.S. households will spend 54% more for propane, 43% more for heating oil, 30% more for natural gas, and 6% more for electric heating. Gasoline is already up by more than 50% from a year ago. The Zillow Observed Rent Index rose a record 4.3% year over year in October, and Medicare prescription drug premiums will increase almost 5% in the next year, according to the Centers for Medicare and Medicaid Services. Yes, Social Security will offer a 5.9% cost of living increase in 2022, the highest in 40 years. The 2022 COLA will increase an average monthly retirement benefit of $1,565 to roughly $1,657. This would be the highest COLA that most beneficiaries living today have ever seen. But there will also be a 14.5% increase in Medicare Part B premiums for 2022, which will push the standard monthly premium from $148.50 to $170.10. To assist retirees on fixed incomes grappling with higher expenses, the Senior Citizens League is urging Congress and Biden administration to issue $1,400 stimulus checks to Social Security recipients. Yikes, I don't think that's a good idea. We're already broke. Now, if the government were to then start slashing jobs like, I don't know, all the alphabet agencies that we got, if we just started firing all those people to then take care of the elderly, I might consider it. That might be a good idea. But, I grew up next to a welfare community and, we spend way too much money on government projects. So anyways, all right. Advice from 3 money pros. Let's see what they say here. Zanelia Harris. It really comes to evaluating your household expenses and necessities. Use portable heaters in the main rooms to reduce natural gas. It might cause a fire. Heat only the rooms that you occupy during the day. That's probably not a bad idea. And also use credit card points toward reducing the price at the pump. I do that. Seek help from local nonprofits or churches. In my hometown, a local church has a pantry that offers free food weekly. My aunts help with setting up the pantry and say people in the town can be too proud to access food. Sometimes pride has to be set aside to receive assistance. Use the AARP card to get discounts on items and services as much as possible, whether that's cell phones and cell phone plans or home and car insurance coverage. All right, the next person, Lisa Kirschenbauer. This year, it's especially important to reassess your medication costs through your Medicare Part D coverage. It's also important to look carefully at your monthly expenses to see where you can cut your costs. Call your utility, cable, and wireless providers to see if you can get a better deal. Look into local programs in your city or county that might be able to help senior residents with support and services. All right, next from Margarita Cheng. The first thing to do is your budget. It's a common theme here. Look at how much you have coming in and your predictable expenses. You will need a liquidity basket to pay those regular bills. There will be a mix of cash and maybe funds to help in an online savings account, money market account, or short-term CDs if that's appropriate. Make sure that you have money for the here and now and the liquidity access to pay your bills. One of the best ways we help combat inflation is with stocks or mutual funds. The stock market's average annual gain outpaces inflation over the long run, not every year. But you don't want to put all your money there. The amount of money you should have in stocks and bonds and cash is a function of your time horizon, your risk tolerance, and your cash flow expenses. That's where you would probably want to talk to a financial professional. I know someone, this guy, and talk with them about what makes most sense. For many people, the easiest way to stay invested is through a target date fund. You can pick a fund with a year such as 2027 in its name. The fund manager then derives up investor cash among its stocks and bonds, shifting the allocation to be more conservative mix as the target date approaches or soon after. All right. So I think that's about it. So, all righty. Well, that's everything I had for today. I've only rambled for 22 minutes. It seems like time just flies by while we're sitting here having a nice time. So I hope everybody's having has a fantastic evening, and maybe say a little prayer for us here in the mountains and along the what do they call the flatland heading towards Kansas, the plains. So it's gonna be real windy, and hopefully nothing gets blown around and and takes us out. So, all right. Well, everyone have a great evening, and I hope I'm back here tomorrow. My boy Jake is back there, wants to go play with that orange ball on the floor. And so everyone have a great evening. And if you need anything from me, drop me a call, send me an email, smoke signals, whatever it takes. And also be sure to like, subscribe, and share with friends and family. I would greatly appreciate it. And y'all have a great evening. Bye.